Hello and welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
What is really in it for VW to spend $5 billion? Why did they need a big stake in Rivian if all they needed was software of, a $2 billion contribution? But for Rivian, this is obviously great news. It doesn't necessarily answer the question of will they be able to get to profitability on their car business, etc., but it lets them fight another day.
A potential spinoff of FedEx Freight draws a lot of interest. Because the margins in freight are really quite good compared to FedEx overall. But don't dismiss, I think, also some of the other, positives from the quarter. Revenues did not miss, which is a nice change to see.
NVIDIA is like the Cisco of our day. If you think about it, it takes about one generation to forget about a bubble. And the average baby boomer was about 41 years old in 1999. They drove stocks up vertically. They loved Cisco. It became the most valuable company.
We've got an hour to go until the market close. So let's take a look at the major averages right now. We don't have much change for the majors today. Up just about 0.1% on the Dow, about 32 points. The S&P 500 very slightly lower, about 0.1%. And the Nasdaq is in the plus column as well today. The S&P equal weight index is underperforming once again as we were looking for those signs of broadening that, at least by this metric, are not necessarily happening. A couple of the things that catch my eye today. One is what's going on with the 10-year. We're seeing another bit of a bump up now in yields here today, back up to 4.32%. And then if you take a look elsewhere, what we're watching today is what's going on with large cap technology here. Indeed, Nvidia is pulling back again after a bit of a recovery over yesterday's session, now coming lower once again, so still lower over the past 5 days or so. But the real standout today is Amazon. Those shares up about 5.5% over the past few days. In today's session, up about 3.5%. Now remember, Amazon owns some 16% of Rivian, which is gaining today on a new partnership with Volkswagen. We're going to talk more about that in a bit. So that seems to be the catalyst here today. But what the effect of it is that Amazon now is at a record and crossing above $2 trillion in market cap for the very first time. It doesn't move it up in the sort of weighting spectrum within the Nasdaq 100, but still that is a milestone for Amazon with that $2 trillion. One final thing I wanted to check on here is what's going on in the sectors in today's session. Let's get back to the percentage moves here. Only one group is in the green today. That is consumer discretionary. There are two main reasons why. One of them is Amazon. It is in that group. And the other is Tesla, which is also gaining in today's session. On the downside, we've got energy stocks and other tech, utilities also lower. So pretty broad-based selling today, with the exception, Josh, of that one group.
Thank you, Julie. Stocks fighting for some gains, as you mentioned today, as investors watch for signs of life in the tech rally and weigh the prospect of a Fed potential rate cut. For more on the latest market moves, let's welcome in now Dave Mazza, Roundhill Investments Chief Investment Officer. Dave, it's good to see you as always. You look at the S&P 500 today, Dave. It's kind of, as Julie pointed out, sort of you're kind of just flat near the flat line here. But if you pull back, Dave, as we kind of second quarter comes to a close, it would seem like investors have some reasons to be happy, right? You look at the S&P 500, it's in the green. It's up about 15% in the first half. And here's a stat, Dave. Sam Stovall at CFRA pointing out that first half return for the SPX, third highest since 1990. So things seem pretty good right now, no?
No, I think the backdrop from a fundamental standpoint is particularly strong, right? We came out of an earnings season where companies beat expectations. But when we peel back the onion, and I think that sector chart that Julie had just showed a moment ago is really emblematic of where we've been in the market, where it's been a winner-take-all market. The mega cap companies, the Magnificent Seven, have really been the star performers. And folks who are looking for a rotation, whether it's to small caps or really even other cyclical sectors like industrials and financials haven't seen it yet. So it doesn't give people really a lot of confidence, even though, to your point, for all intents and purposes, they should be particularly bullish. Look at money market assets, money in money market mutual funds are at all-time highs. So it's sort of this weird environment where folks are seeking out safety, but in the stock market, they're doing it with the mega cap companies.
And is that okay, for lack of a better way to ask that, Dave? In other words, there's been a lot of debate lately about how sustainable a rally can be when it is led by just a handful of mega cap stocks. So far, it's been fine in that regard. But I guess the question is, can it continue to be?
Well, yeah, I think everyone would feel more confident if we saw equal weighted indices making all-time highs along with the broader market. Of course, small caps are far from an all-time high. And meanwhile, the S&P 500 has made over 30 on a year-to-date basis. But I actually think it's okay, right? We want the market leaders to be leading, right? They demand the highest weights in indices for a reason, because their net income growth, their profit margins, their revenue growth have really been incredible. And it's because there's really been two themes driving the market. That's spending on AI, and then separately is interest in weight loss stocks. But I think when it comes to the broader indices, of course, it's been that AI relation. But today's move is really important, right? Nvidia, of course, had unbelievable performance. Been a bit soft, right? Was down over 10% in recent days. But now more recently, of course, Amazon's coming on strong today. Tesla's been having a bit of a bounce. So I think investors are clearly not giving up on the markets, even if folks are all hoping or wishing that there will be more companies that are participating at the same time.
You mentioned, Dave, NVIDIA and that AI trade. So I'm just curious, as a strategist, how enthusiastic, how excited are you about that mega AI trend? And what do you think are some smart ways to invest in it?
Yeah, so it's interesting. When we think about AI, particularly generative AI, we remain in the very early days. And the companies that are making the picks and shovels, right, really the oil or gold, which in this case is the semiconductors themselves, have benefited the most. And Nvidia in this winner-takes-all environment has been the big winner, even relative to its semiconductor peers. We still believe that there's a lot of potential in generative AI and in AI. It's an area that we're bullish on. But when we think about the potential for revenue to continue growing, we're going to need to see it. And that is an area where I think people may have gotten a bit ahead of themselves on where the spending's going, right? Folks were starting to look at software names like Salesforce and ServiceNow, two great companies, but we're not seeing the spending on generative AI there yet. They themselves are spending on generative AI. So for the time being, I think it remains very concentrated, where names like Nvidia, the people powering it, the enablers, Dell, Supermicro, they're going to be where revenue growth comes from. And the seeing that happen with software will come, but likely later in the year, if not into 2025.
Well, that's what I was going to ask about, is timing. This is exactly what I wrote about in the Yahoo Finance Morning Brief today, Dave. And it was based actually on a note from Guggenheim's John DiFucci, who covers software. And he made exactly this point. He was looking at some recent budget surveys on the part of enterprises. And he said they're going to grow like 3.5% this year, but it's not going to see a reacceleration of growth because they are not yet seeing the value being proven for them from AI. So, what is going to be that turning point? So, as you say, that a sales force, that clients start spending with it on AI rather than it itself spending on AI.
Yeah, so it's interesting. So that's a company that really is by far and away the leader in CRMs. But their top line growth in the most recent earnings season certainly was disappointing. And until we actually see companies willing to spend on additional services and resources in the AI space, so meaning maybe co-pilots for every employee, making people a power user, that's the holy grail, right? Where we can add AI into our processes and we're all going to be more productive. I totally agree with that note, because we're not quite there yet. And for now, I think investors need to be confident that the AI trade is actually in the early days. The most obvious names are being picked over, right? That's one of the reasons why Nvidia has skyrocketed. But actually, that rotation does get pushed out for some time. Doesn't mean it's not going to happen, especially when we think about where corporate spending is going to be. It's going to be on cyber and it's going to be on AI going forward. But the economic environment remains uncertain. So I don't see companies plowing further into where their plans already are. Right now, they're buying chips.
Interesting. All right, Dave, thanks so much. Good to see you.
Thank you.
Let's check in on a trending ticker that we are watching and then sort of a ripple effect from that trending ticker. Rivian is what we're talking about here today. The share soaring up almost 19%. The company unveiled a software partnership with Volkswagen, and as part of that, the EV startup will get up to $5 billion in investment from the German automaker. Initially, it's going to be $1 billion investment, and then it could end up being more. They're going to have a jointly owned software company that will use Rivian's technology as the basis. Volkswagen's been struggling a little bit with its own homegrown software in this area. Why is this so important? Well, Rivian has been burning a lot of cash, and it needs sort of a bridge to get to the introduction of its next vehicle, the R2, which is its lower priced pickup. And so this is really seen as a big relief on the part of investors. Yeah, and I think this is my favorite note on this today. Relief. Giant relief. That, Julie, is how the team at Canaccord Genuity put it. George Gianarikas responding to this news that they secured $5 billion in financing. Bottom line for George, he told his clients, despite the prevailing narrative around EV malaise, and really, Julie, that's all we've been talking about, honestly, he sees the auto industry's journey to electrification as highly likely. Kind of made some comparisons, George thinks, kind of the smartphone and streaming industry transitions we saw in years past. Believes Rivian is poised to emerge as a future EV leader. They kind of talked about the R2 now, R3. He thinks have the potential, this is his argument, to propel Rivian into the American public's consciousness. So he sticks with his buy in Rivian. His target is 20. Adam Jonas also caught my eye with some of his commentary. He's gotten overweight on the stock too, although from this comment, it doesn't necessarily sound like it. He says, while the billions buy valuable time, the bigger question is whether Rivian can genuinely improve the business, potentially turning what he calls the joint venture first date into something that can sustain a lasting competitive advantage. Rivian has been such an interesting story here. The valuation peaking at $153 billion back in late 2021, I believe. And now it's what, around $15 billion? Well, all this, we talked to Praz about this when the news broke yesterday. I mean, there was that narrative out there. I mean, real questions about what was the story for this company going forward. Definitely. As we mentioned, Amazon owns about 16% of it. So that's one of the things that appears to be propelling it higher today. One stock that's not higher, though, related to this story, is a company called Aptiv. And that's because it has a relationship with Volkswagen, and so look at that. This could potentially be negative for it, although it seemed pretty speculative. Most analysts weren't sure exactly what effect it was going to have, but it seems like people are selling first. Some people placing bets. Yeah, seems like it. We're just getting started here on Market Domination. Coming up, shares of FedEx soaring today on the back of the latest earnings report. We'll check out on the stock as well as a few other trending tickers on the other side. Plus, Joe Biden and Donald Trump are squaring off tomorrow evening in the first presidential debate of 2024. We'll break down both candidates' tax policies later in the hour. And at 3:30, it's the latest edition of our series, Goodbye or Goodbye. Stay tuned. Much more Market Domination still to come.
Chipotle slipping in today's trade. That says the company's 50-to-1 stock split goes into effect. And Julie, as we know, that was effective after the market closed yesterday. Of course, you know, Chipotle had enjoyed this very strong run, so much so that the stock price did get out of reach for a lot of our friends and neighbors, and so hence the split, which we have seen with a couple other names, Nvidia, for example.
Right, exactly. It feels like it's a trend, even though, as you and I were reading in a Bloomberg analysis earlier,
that was a good piece. Very good.
It's sort of a recent trend, but like far cry from what we used to see in terms of stock splits. You flagged these numbers.
I thought that was really, that was a really interesting report. How basically splits used to be a lot more popular than they were. There were 114 companies in the SPX announcing splits in 1986. That was 4. A record. Yeah. There were 4 in 2023. And in part, we've seen a bump this year, but really, Bloomberg pointed out it's really because of the rise of fractional shares, a way to buy a portion of a share of stock. That was something brokerages started offering a few years back. And so that feature, as Bloomberg's kind of pointing out, maybe dampening the popularity a bit.
But the other key now that's bringing splits back, according to Chipotle CFO Jack Hartung, who's quoted in this article, is that if you're giving employees stock, then it's harder the higher your prices. You have less flexibility in terms of number of shares and then upside that you can give out to folks. So I thought that was an interesting point as well. Let's talk about FedEx, too. Those shares soaring after topping estimates in the fiscal fourth quarter. The company sharing more details on the success of its massive cost-cutting initiatives and unveiling plans to repurchase up to $2.5 billion worth of shares in its fiscal year, which has already begun, fiscal 2025. The company also, in a bit of a surprise, saying it's exploring options for its freight business, which also analysts seem to like here. But also the forecast for the full year was also a pleasant surprise for investors.
Yeah, they did. Listen, they forecast profit above consensus, not buying back $2.5 billion of stock for the next year. But to your point, Julie, I think ears did really perk up around that freight business. They talked about assessing the role of that unit in the portfolio and, quote, potential steps to further unlock sustainable shareholder value. They said we're committed to completing this review thoroughly and deliberately by the end of the calendar year, and certainly that made some headlines and got some attention. Yeah,
this amidst the backdrop of a lot of cost cutting and efficiency finding at the company. Well, one more here, Moderna. That stock falling after the company said its newly approved RSV vaccine was only about 50% effective after 18 months. Yahoo Finance Anjali Kamlani following the story. She joins us now for more. RSV was going to be a big deal for them.
It was, yeah.
Or maybe still will, but this is a blow to it.
It could still be. Well, we're seeing the stock down right now because investors are looking at the Moderna drug vaccine compared to Pfizer and GSK. Those two also in the market in the same 60 and older population. And what we're seeing is that Moderna's efficacy after a longer period of time is much lower. If you take a look at GSK, they have 68% and Pfizer at 77% over longer periods of time. And this data came out in a CDC advisors meeting that took place today, and they still voted unanimously to allow all 3 of these and to recommend all 3 of these vaccines on the market for 1 dose for those 60 and older. So that's going to be what the market looks like. Now, this is a $444 million opportunity for Moderna, according to JPM. But as we know, CEO Stefan Bancel has had his eye on the RSV market for a while, thinking about the broader opportunity. Here's what he told us last month.
RSV, anticipating the launch this spring. If you look at analyst consensus, the RSV market could be around $10 billion market. So it's a big market. It's bigger than the flu market in terms of dollars.
So as you can see, looking at that $10 billion as a potential, what Moderna's actual take of this market will depend on whether or not those efficacy numbers matter to the CDC, who will make the ultimate decision, as well as to providers.
And Anj, we saw this new proposal today for seniors over 65, I guess, get their weight loss drugs paid for by Medicare. What can you tell us about that one?
Yeah, that's a new bill. Well, so this is a bill that's been languishing literally in Congress for over a decade. Eli Lilly and Novo Nordisk have been lobbying for some passage of this bill for some time. So finally, the House Ways and Means Committee came out with a proposal that is far more limited than the original proposal. And in this proposal, what they say is that seniors who have been on the drugs, these obesity drugs specifically, for at least 1 year before getting onto Medicare can get continued coverage. And this does not include those who are overweight with one related disease. That was part of the previous version of the bill. There is a vote slated for tomorrow, which is the first time this bill could get as to that milestone and that far. And we've covered here at Yahoo Finance how these two companies have been really hoping for that vote to go through. So we'll see if it does pan out. That is when the Congressional Budget Office will also get some kind of estimate on what Medicare's price tag will be if it goes through.
All right, yeah, that would be pretty terrible if you're someone who's on one of these drugs and coverage goes away when you turn 65. All right, thanks, Hanj, appreciate it. President Joe Biden and former President Donald Trump are squaring off tomorrow evening in the first presidential debate of 2024. Both candidates have signaled the tax policies that they're promising. Here with us to talk about the key questions going into the debate is Erica York, senior economist and research director at the Tax Foundation. Thanks for joining us, Erica. So in broad strokes, we kind of know the outlines here of what these two candidates are proposing, right? Trump would extend tax cuts, for example. He's talking about tariffs. President Biden is talking about a higher tax on the wealthy and potentially on corporations as well. So what do you want to know, what do you want to drill down on and know about that you think might get answered in the debate?
Yeah, we've heard these big picture outlines from both candidates on where they would take tax policy, but they've been extremely light on detail. For instance, both Trump and Biden have mentioned extending the 2017 tax cuts in some form or fashion, but they don't address what they would do for the $4 trillion price tag that would bring along. Given where debt and deficits are now and CBO projections that just came out in the last week saying deficits are higher than we anticipated, that's a question that ought to be answered with some real honest accounting of the trade-offs of whether you're going to fully extend the taxes and create this big hit to the federal budget, or whether you're going to offset some of that, which means some people would have to see tax increases.
And Erica, Treasury Secretary Janet Yellen spoke with Yahoo Finance this week, and Trump's tax policies came up, and specifically those 2017 tax cuts. Take a listen to what she had to tell us.
Look, I'm governed by the Hatch Act, and I can't get into electoral politics. I guess I could just make a couple of policy-oriented comments, which is that the signature policy from the Trump years was the Tax Cut and Jobs Act, and it promised an investment boom, which really did not materialize. It gave huge tax breaks to corporations and to wealthy individuals, and it resulted in an enormous increase in the deficit and lowered tax revenues below historic norms.
Eric, I'm curious to get your reaction to Yellen's comments there. Do you think those are fair? Are they accurate?
Politicians tend to overpromise on the effects that their signature policies will have. So we did hear some rather wild promises about what those tax cuts would achieve. But if you look at what economists like us at the Tax Foundation predicted they would do, and you look at the academic literature that's coming out now, you find that, yes, indeed, when you lower the tax burden on investment, you get a response of increased domestic investment. And that's exactly what did happen after the TCJA. So I do think on those grounds it was successful. But then it was also a tax cut, as was in the name of the legislation. It was designed to reduce taxes, particularly for individuals. And we saw average tax rates go down across the income spectrum, whether we're talking about the bottom half of taxpayers, the middle half, or the middle quintile, or the top 1%. It did successfully bring average tax rates down as it intended. And so the question going forward is, if you let the tax cuts expire, about 62% of taxpayers would see their tax bills go up starting in 2026 when those would expire. Do we want to increase taxes for 62% of Americans, and in doing so, worsen these incentives for work and investment going forward?
And if you don't do that, then how do you pay for it, I guess, is the flip side.
Yeah, that's the question that both Trump and Biden need to answer, hopefully in the debate tomorrow, because President Biden in his budget has said that he would continue the vast majority of the tax cuts for people making under $400,000, but hasn't spelled out how he would offset that price tag, and neither has Trump. It will require tough decisions about, broadening the tax base, further limiting itemized deductions like the TCJA did in part, but going all the way to offset the cost of lower rates. No easy answer when it comes to tax reform, and especially when it's in a revenue neutral manner. That means you do have to give up some tax provisions in order to pay for the tax reductions elsewhere.
And also, Eric, I'm just interested to get your take on another topic that could come up tomorrow in the debate, which is tariffs. I mean, Biden and Trump, they have different approaches, but they both embrace broadly the concept. I'm just curious, Eric, as an economist, how are you thinking about tariffs, that dynamic, and the impact on the economy?
It's extremely unfortunate that both Donald Trump and Joe Biden are willing to walk down the tariff path. Trump a little bit further, or quite a bit further than Biden, but nonetheless, both go in the wrong direction. Look, we've got lots of evidence from the 2018-2019 trade war that the tariffs Trump put in place and that Biden has maintained and now increased cost American consumers, hurt manufacturing output, reduced jobs, resulted in retaliation that harmed American ag producers, resulted in additional taxpayer costs to bail out those ag producers, and didn't improve trade relations with China. So a lose-lose situation. And it makes very little sense to continue those tariffs when the costs have very clearly outweighed any small benefits that you could try to look at under a magnifying glass. But unfortunately, that's where we are. Both candidates seem to be trying to one-up each other on tariffs and also say, my tariffs won't cost the American consumer, but the other guys will. And we know from really recent experience that the story that they're telling on tariffs just doesn't line up with how they're already playing out.
All right, we'll see if the topic comes up tomorrow. We'll be watching. Erica, thanks so much for joining the show today. Appreciate it.
Thank you.
And coming up, it's the latest edition of our series, Goodbye or Goodbye. We're going to take a deep dive into two stocks to help you make the best moves for your portfolio. Stay tuned. Much more market domination still to come.
It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal to help cut through that noise to navigate the best moves for your portfolio. Today, we're tracking the shift in consumer spending on food. I'm here with Tomatica Research Chief Investment Officer Chris Versace's back with us. It's good to see you.
Good to see you.
And your Goodbye has actually been a sort of a popular one here on Goodbye or Goodbye, and that is Costco. It's very popular on the Yahoo Finance platform as well. The shares are already up more than 60% over the past year. So let's get to why you like it here. Sure. And we've seen some shifts, like throughout the pandemic. Obviously, people were eating at home then they went back out again. Now they're going back home, it seems like.
Yeah, absolutely. You know, whether or not we measure up recent retail sales reports or we look at some of the survey data out there, people are, feeling the pinch of continued higher prices and they're shifting back home. Probably the best data point I can give you on this, Julie, is something new from the Philly Fed. They put out all these different surveys, and it shows that about 43% of consumers surveyed are clamping down on discretionary spending, particularly eating out. So I think this is a great way to play it, and I say this because most people don't think about this. Costco gets about 54% of its product revenue from fresh foods, food and sundries. So it's extremely well positioned. It's also the largest seller of beef in the world, but that's beside the point.
Wow, I did not know that. Okay, so there you go. So if people aren't going out to eat a steak, they want to save some money, they're throwing that steak on the grill at home. Secondly, you think they're taking consumer wallet share. And this is sort of part and parcel, right? Because they are seen as a value within this whole chain.
There is no debate about this. So, the great thing about Costco is it reports monthly sales. Right? So you can take a look at what their comp sales are, you can take a look at what they are on an adjusted basis, then all you have to do is measure them up against what we see from the Commerce Department with the monthly retail sales report. And when you do this, there's no question Costco is taking wallet share.
Interesting. And how are they doing that? Is it the value proposition or are there other things going on?
I think it's the value proposition primarily. I would say I'm going there for the hot dog at $1.50, but it's more of extending the disposable dollars that you do have. And if you've been to Costco, you know that it's extremely hard to beat. They've done a great job, like we kind of talked about, leaning into grocery. Just size up what Kroger said today against what we see with Costco. And again, they're clearly taking share.
Okay, and then finally, they haven't raised the fee yet. Everybody's waiting for it to happen, the membership fee to go higher.
Yeah, I mean, they have roughly 75 million, memberships out there. At some point, they are going to raise this, whether it's $5, $10, to you and me and everybody else who shops there, no big deal. But for them, across the entire membership, that's a huge number. And the key here is that this high margin membership fee revenue stream is about 50, depending on the quarter, 60% of net income. So it's a real differentiator for Costco, but at the same time, they continue to grow the warehouse footprint, fueling continued growth in the membership fee.
So let's get to what could potentially go wrong with Costco. One is they decide not to raise the membership fee anytime soon. And secondly, there's the other piece of what you talked about, that they don't expand the warehouse space as much as anticipated.
100%, although this one I would say is very low, if only because the management team over the last several conference calls, when they report the earnings, have said, yeah, it's just a matter of time. We will do this, and I think when we get it, you'll see earnings expectations move higher, price targets move higher as well.
Gotcha. And what about the second one?
Well, I mean, look, if we start to see interest rates come down, I'm thinking one Fed rate cut later this year, a couple more next year, that's going to help improve their hurdle rates. I do think that there's room for them to continue to expand, not only in the U.S., Canada, call it North America, but also outside. They've only got a handful of locations in China and other territories that you could see even greater penetration.
All right, so let's get to the stock you don't like as much here in the food area. We're talking about McDonald's. These shares are down about 10, 11% over the past year. So it's sort of the converse, or the inverse, if you will, of Costco. The people are not eating fast food as much.
Right. I mean, and it's two parts, right? So as we talked about, people are not eating out as much. They're feeling that pinch, but at the same time, take a look at what we've seen for price increases in fast food, where in some cases it's almost on par with fast casual, right? A Chipotle or something like that. It's no longer the cheap alternative.
Interesting. Even though, I mean, they have rolled out the value meals, though. I mean, now there's sort of a value meal war going on.
Yeah.
You don't think that's going to be enough?
Well, to begin with, there's the, what is it going to cost them on the margin side? And at the same time, there's the competitive response. So how long does this go on for? That's my bigger concern, right? Leading with price, good in the short term, but it's very hard to kind of drive those margins higher over time if you're leading on price.
Well, especially as they still have wage pressures wages are not going down, certainly, for fast food workers. And so the margins they don't have a lot of flexibility, I guess, on margins if they're offering these value meals.
Well, so there's a couple things here, right? So you are 100% correct that wages are going higher. Take a look at what's happening in California. That's really going to hurt them. I think Brian Sozzi posted something about that yesterday. But at the same time, we could look at ADP's monthly pay change data. Job stayers 5% year over year, pretty consistent the last several months. Job changers even higher. But you talk to some of these hiring managers at local McDonald's or other fast foods, still very tough to find people because of what they want in terms of wages. And then at the same time, we've got other dynamics at play here where if these companies want to overcome this productivity issue, they have to invest, whether it's AI, robotics, what have you. So you're having margin pressure, but you've got to invest at the same time. Something's got to give.
Yeah, interesting. Okay, so what could go right here? Maybe a little bit of an alleviation of input costs, which we've seen some of.
We have. I mean, beef prices, chicken prices have started to come down. When you think of McDonald's, burgers and chicken, that could be helpful to them. But I think that's going to be offset by some of the factors that we talked about.
Gotcha. All right, so let's just quickly tell folks what positions you have, if any, in these two.
Sure. So in the Street Pro portfolio that I manage, we are long Costco shares. We've got an $8.80 price target, but we think once we get that price target, once the membership fee increase comes through, we're likely to raise that. And McDonald's, I would say simply, Julie, not loving it. And we actually sold the position in McDonald's that we had very early in the year because of some of these concerns, particularly about the minimum wage increase in California.
Okay, interesting. Chris Versace of Tematica, good to see you.
Good
Thanks
to see
for
you.
coming in. And thank you so much for watching Goodbye or Goodbye. We'll be bringing you new episodes at 3:30 p.m. Eastern. Josh?
Thank you, Julie. Let's get to some calls of the day now. First up, Campbell's. JP Morgan upgrading the soup maker to overweight from neutral, a price target of 52. And Julie, JP Morgan saying this is its first overweight recommendation on the stock since 2009, by the way. So it has been a while, but they like it now. And I went over some different reasons why. They told their clients, listen, we think consumer demand for those Sovos products, mostly Rayo's, remains excellent. They see the potential for modestly greater Sovos synergies down the road. And third, and perhaps most importantly, they say, Julie, Campbell's longer-term margin potential might be bigger than the street expects.
Yes, they say that's thanks to what they call self-help efficiencies. What the heck is self-help efficiencies? You can kind of take out the self-help. It's efficiencies. It's the company cutting.
I like the self-help. That's a nice little ring to it.
Self-help. It's them helping themselves by cutting costs is what it seems to me that they're referring to here. So that's what this has to do with it. They're getting leaner and meaner at the same time that they have this potential growth engine in Rayo's and the other Sovos products here. And so that's why they think the margins are going to beat what the street is looking for. It's interesting, this coming after the folks over at JP Morgan, led by Ken Goldman, met with the executive team at Campbell's. And it sounds like they wwere convinced by what they heard.
Yeah, I got the Lipton pantry, a lot of Rayo's.
Oh, is that right?
Big
Wow,
Rayo's.
you're a splurger on the sauce, huh?
I'm splurging. Well, you live once. Life is too short.
Yeah,
too
you
short
gotta
for
have
bad
the good sauce.
Julie. You know that. All right, another call of the day. Let's get to this one. This is a good one. Wolf Research upgrading Robinhood to outperform and boosting its price target to $29 a share. And joining us now is Stephen Chubak, Wolf Research Managing Director. Stephen, it's good to see you. So it sounds, Stephen, like you hosted a dinner with the company's CFO. You must have liked what you heard, Stephen. You go to outperform on the name, targets 29. How come, Stephen? Let's talk big picture. Why do you think this is a name to buy here?
Yeah, well, first off, thanks for having me on the show. Look, I want to give some different perspective because Robinhood is predominantly covered by fintech analysts. I'm actually a financials and banks analyst by trade. But really what's underpinning our thesis, what we're looking for is durable earnings growth, upside to GAAP earnings. So forget the non-GAAP adjustments, underappreciated growth levers and a reasonable valuation. And so we came away from the dinner, quite constructive, just given there's a lot of growth runway ahead for this company. As we started to underwrite some of the levers that they could pull on the crypto side, active trader, expanding internationally, our estimates shook out 70% above the street, 70.
Wow.
And so it's very rare that we see that mind the gap, so to speak, or that upside relative to street numbers, where effectively the analyst community is not modeling any growth over the next 2 years. So definitely a lot of room for them to surprise positively.
Yes, Stephen, what do you think they're missing? What do you think the street's not seeing when it comes to Robinhood? What are some of those growth levers that you would zero in on?
Well, I think the most important component is actually expenses. So there is a tendency to focus on a lot of the brokerage metrics. But what's really going to drive the earnings growth from here is the fact that they have a highly leverageable expense base, where our expectation is that 90% of their expenses are fixed. They are going to see 75% incremental margins. So for every additional dollar of revenue, you're going to have 75 cents of that dollar fall to the bottom line. And it's that operating leverage that people are not adequately reflecting in numbers. And that's really the biggest source of upside. But even in terms of revenue momentum, they're growing organically at 20%. They're growing accounts at 5%. And that supports 20% revenue growth roughly. So as you start to think about that earnings growth algorithm, they're going to grow earnings at 30% annually. And the street is not reflecting any growth over the next 2 years.
You look, though, at this chart here, Stephen. I mean, what a move already, right? I mean, the stock's up about 75% this year. It's up about 130% over the last 12 months. I mean, how does valuation look to you at these levels?
Yeah, it's a good question. I'm glad that you asked, because I think it's important to really parse what's driven some of the outperformance over, and let's just use the year-to-date number of 74%. It's exclusively driven by estimate revisions. There has been no multiple expansion for this company. I cover 28 names. There are only 2 that have actually seen multiple contraction, and Robinhood has seen no multiple expansion despite 74% gains in the stock price. And so that's a really key differentiator. It's all been driven by improving fundamentals. It's not a function of a higher multiple. And so it's a much higher quality source of price strength that I don't think is adequately contemplated by most folks. And so for us, so long as estimates continue to get revised higher, this stock is going to continue to rally. And that's really what the data is showing us. The stock price is 91% correlated to estimate revisions, and we expect that estimates are going to be revised 70% higher by 2026.
One funny little part of your note, I have to say, Stephen, was when you said what this upgrade is not. You said it's not a bullish view on crypto price appreciation, meme resurgence, or anything roaring kitty. So their growth, those estimates, are not contingent on sort of these various zeitgeisty things that come into the market.
That's exactly right. For us, it was really important that we could identify drivers that are durable and sustainable to drive that growth. The fact that there's going to be an occasional meme frenzy, or we're going to go through a crypto winter, we're really trying to normalize for all those factors. So normalizing for activity rates, normalizing for account growth, normalizing for organic growth. What does that mean in terms of earnings growth potential? And again, it supports an algorithm that leaves our estimates 70% higher than where consensus is today. And so long as those estimates get revised higher again, this stock is going to continue to outperform. There's been a lot of noise on the regulatory front. There's been a lot of noise on the retail front with Wall Street bets and the like and Roaring Kitty. That's all noise to us. That did not factor into our thinking at all here.
Stephen, thanks so much. Interesting stuff. Good to get your insight.
Great. Thanks so much for having me. Really appreciate it.
Coming up, we've got the best way to play commodities against the election backdrop in our investor playbook next on Market Domination. President Biden and former President Donald Trump take the debate stage tomorrow night. With the election fast approaching, we're taking a look at how the uncertainty in election years affects commodity prices in today's Investor Playbook. We're joined by Phil Strebel, Chief Market Strategist at Blue Line Futures. Phil, it's great to see you as always. Let's sort of tackle the oil and gas complex first, because although it's very complex, obviously, because we've heard some rhetoric from President Biden, but the oil and gas industry has flourished as he's been president. So what should we be looking out for, and how could that actually affect the underlying commodities?
Well, really, I mean, trading in any of these commodities, whether it's metals, precious metals, energies, or agricultural products, I mean, the candidates are so far apart that it really opens up the door for a wide range of volatility. I mean, energies are one of the top focus that we're going to be watching. Under Trump, we were energy independent. We did also have a hard stance on Iran. So, you know, it makes a play for lower energy prices if Trump was to come into office, where we are much more dependent on OPEC, South American oil. It's very difficult for oil and gas exploration companies to get those permits requirements to expand wells. And with the green energy initiative front and center under the Biden administration, it's just really tough with the regulations in order to boost that output. So you're going to see more elevated energy prices with Biden around.
Between now and the election, though, Phil, so a more near intermediate term, I'm just curious, with Brent, we're just under 85 here. Where do you see us headed from here? Again, near intermediate term.
Yeah, we've had an incredible run up here just recently on the crude oil product, and it looks like we are running into some short-term resistance. We could see a small setback, but not too deep of a setback whatsoever. There are still a lot of geopolitical headlines that are lingering out there. It looks like Israel has finished up with their first initiative. They might take something more on the Lebanon border, so you might see things heat up there a bit, and then all of a sudden oil will be front and center. Geopolitical risks will be rising, so that's going to be something to keep an eye on.
Well, and Phil, at the same time, obviously gasoline prices are a big pain point for the current administration and President Biden's poll numbers. And so are we going to see, I guess what I'm asking is there going to be a ceiling on gasoline prices and maybe oil prices by extension in the run up to the election? Are there any levers that we can expect them to pull?
So the thing that we're really watching is shifting more towards the Fed, because we think that the Fed, if they cut interest rates ahead of that election, it's going to work as a double-edged sword. Well, you'll start to see some of these commodities, some of these inflation pressures start to rise because naturally speculators are going to come back into the market. But if you do get also the interest rate cut, you'll see like housing prices come down, debt burdens and things like that. Gasoline's tough. It works off of a lot of seasonal factors and things like that. It's U.S. production and other things. Something else that people really got to pay attention to if they're watching the debate is going to be, Trump's stance on China. He was so hard on China, and because of that, we saw this trade war, and agricultural prices had dipped significantly in the U.S. as China shifted focus to buying eggs from South America. So it's not only just metals and energies and the precious metals, and it's a lot of other commodities out there that could really play a role. The Fed is supposed to be, it's perceived as apolitical, but I mean, if they make that first interest rate cut, they could really boost some momentum within the economy ahead of that.
Phil, I want to switch the metals and specifically gold and get your thoughts there. As you point out, Phil, gold futures hit that all-time high May 20th. Since then, corrected, consolidated. What do you see ahead, Phil?
Yeah, really tough. Tough month to date on the gold market, down about 2%. The dollar index making 2-month highs right now. You look at the 2-year and the 10-year note, they both broke out to the upside. 2s versus 10, the yield curve steepening again. So no real clear signs from the Fed. 1 minute you get Mary Daly coming out, and she's very dovish. The next day you get Michelle Bowman, another Fed speaker, coming out very hawkish on the market, saying that, if inflation ramps up, they might have to raise rates again. I find that hard to believe. And then the other problem is that you have Europe. They're really having some problems going on. They're going to have to cut rates probably 2 more times. The inverse correlation of the dollar boosts the dollar index up, weighs in on precious metals and other commodities out there.
And I know that you were looking at the history of what gold has done in these past cycles. So I think we have a chart of what gold looked like from November 1st, 2020 through January 30th of 2021. And we see sort of a sideways to slightly lower movement here. So what do you think we can potentially expect this time around, and how should people position?
Yeah, the problem with looking at gold, and if you're going to compare like the first year that Trump was in office, it took off because, well, in the end, it took off because of the fact that we had COVID. We were, things were dire. Government was sending out payments and things. The printing press was, we were just trying to stabilize and backstop things. I really think that it's going to be the Fed that determines it. You're going to get maybe a little bit of geopolitical risks. I think if Trump was in office, he would take a much harder stance, on certain countries like Russia, and then also on Iran. And then that could create some problems. You could get North Korea. They start to chime in and they start to shoot rockets and things like that. So, some of these risks will come up. I think gold, though, has kind of a floor because of the fiscal spending that we've had, the uncontrollable debt. And I think that central banks just globally are just not only de-dollarizing, but they're also just currency. They're getting rid of currencies that they don't necessarily find as trading partners anymore, and they're taking a natural shift to owning gold. So if we get central bank buying again from China on gold, I think the party will be on, especially if the Fed cuts rates.
Phil, good to have you on the show. That was a great discussion. Thanks for joining us.
Yeah, thanks for having me.
And while we're wrapping up today's market domination, don't go anywhere. We've got you covered with all the action following the closing bell, including the latest earnings reports from Micron and Levi Strauss. Stay tuned for market domination overtime. That's the closing bell on Wall Street, and now it is market domination overtime. Julie is over at the Interactive to check in on where the major averages ended up. Julie.
Yeah, let's just give you a quick check here. All the major averages actually ending in the green by the end of the day. That was not the case earlier, but really just squeaking it out here. Up almost 16 points for the Dow Jones Industrial Average. The S&P 500 peeking into the green just at the end of the session here, a little more decidedly, although decidedly is still not even 0.2%. And the Nasdaq, the winner on the day, up 0.5%. We continue to not see broad participation here. The S&P equal weight index down 0.5%, but Nvidia didn't rise today. It was the other sort of big cap, mega cap tech companies. Amazon, for example, as we talked about earlier, at a new record and above $2 trillion in market cap. For more on what's going on in the markets, not just today, but to broaden it out a little bit, we're bringing in Mark Newton, Managing Director and Global Head of Technical Strategy at Fundstrat Global Advisors. Thanks for being here.
Julie. Great to be here.
I want to get to some charts that you are watching to kind of help us direct us as to where we're going. So here's the S&P 500 going back to the beginning of the year, actually going going back several years. And you've talk us through what you're seeing from a technical standpoint.
So it is important to know the S&P continues to be dominated by so many large cap tech stocks. So the broader market has not been doing as well as the S&P, but yet we're up 14.5% year to date. And so, a very nice uptrend. Tough to find any issue with that, except if you don't own any technology, then you've obviously performed much worse. A lot of reasons to be constructive about the market. We're heading into a very bullish time of seasonality in election years. July tends to be very, very good, similar to June. I think a lot of investors remain worried about geopolitical risk, about political risk, and the fear of growth slowdowns. But the bottom line is, technically, we have over 70% of all Russell 3000 stocks above their 200-day moving averages. That's actually a much healthier sign. So, yes, despite the minor breadth erosion we've seen in recent months, markets technically are still on very sound footing. And, typically during election years, they do tend to rise through about August, September before peaking and then selling off into the election. So I have no reason to say, without any evidence of trend deterioration, that can't continue. I'm actually still quite constructive. I think S&P gets up towards 5650 or so. First part of July tends to be very, very bullish. It's normally one of the best parts of election year, first couple weeks in July. So I think it's worth considering that May PCE might dip. That would cause a plunge in rates and the dollar, and actually stocks would rebound, and we'd see more of a broad-based rally, which we haven't seen in some time, and investors are anxiously looking for.
Very interesting. I want to dig into the breadth question a little more, because this has been so much a topic of debate lately. So this is a chart brought to us by Bloomberg, where they looked at the S&P 500 in blue. Then it's the percentage of stocks in the S&P above the 200-day moving average. That's in purple. And they've highlighted these areas where we've seen big gaps. Right now is one of those areas. So the S&P continues to rise, but it just shows the momentum is not there for many of the stocks within it. How much does that matter?
Well, it matters just that investors understand that it's happening, and it doesn't have to mean that the market is going to go into a correction or roll over. Those tech stocks can continue to go up, and the divergence can get wider and wider, similar to what we saw back in 2021. However, we can also see what I think is going to happen is as a start of the broader market to play catch-up. And we've seen a little bit of that in financials over the last week. We've seen it in healthcare with sectors like biotech breaking out. We've seen it in industrials. The Dow Jones Transports actually broke out of a very well-defined downtrend today. That gives me a little bit of optimism that investors are skittish. We don't quite see the ebullience and the complacency, but at the same time, the broader market is slowly but surely starting to show evidence that it's ready to start moving higher, which I do think happens in July.
So let's look at the S&P equal weight. This is the Invesco ETF that tracks that. And so are there also technical indications here that give you optimism that we're going to see a little bit of a breakout?
Well, not yet, no. Okay. The answer is, of course, no. But I mean, look, this is a well-defined triangle pattern for those that look at technical analysis. Anytime you see a huge run-up that then turns into a triangle, 9 times out of 10, you do get a continuation move, meaning we break to the upside. I happen to think that because I feel that rates are going to start to plummet along with the dollar, which is very counter trend right now in terms of a narrative. But I do sense that the data is going to continue to get weaker along the fringes. Inflation should start to fall like a rock. So despite the fact that gas and food prices are high for everybody, you have been seeing some evidence of broad-based inflation starting to come down. And I think that's going to be encouraging, not because a weak economy means stocks are good, more that the Fed's rate cut view will come back into line, and we'll have a little bit more clarity as to when they start cutting rates. But yeah, make no mistake, since March, look, it's been a tougher market if you don't own tech. The market's literally been sideways, very different than last October through March. So yes, we do need to see that evidence of broad-based movement. I think that happens in the next few weeks. I honestly am pretty optimistic we're going to see it turn back up.
We got to get in one more quick one, and then we got to send it to Micron here because we've got some earnings coming out. Nvidia, because this is the chart that a lot of people are looking at here about whether we're going to continue to see upside for this one.
Look, it's technically and fundamentally very dominant right now. 3 days, it lost $300 billion in market cap, but you notice the S&P only lost about 1%. So it didn't really have the kind of extent of damage to the broader indices that many people thought might happen because it is over 5% of the S&P.
Yeah.
I like Nvidia. I own Nvidia. I sent out a note to clients saying 115, 116 is really rock hard. short-term support, if it gets under there, there's a long-term uptrend over the years. It hits right near 105. I think this company is going to continue to outperform. The Blackwell chips are going to be a big deal. Customers are still double and triple ordering. Technically, sure, it's overbought, but that doesn't mean you sell, and that's an important reason. We haven't seen any evidence of trend deterioration. And now we know that Nvidia is being bought by XLK and other ETFs, and it's tough for me to avoid it. For many of you that know our product, Tom Lee, it's a super granny shot as part of his list.
Yeah.
And there's a lot of reasons to still embrace it. I think it goes from 118, where it is now, up to likely near 140 into the middle part of July, which would be a big move in a short period of time. So I like it.
Mark, really great to get your perspective on all of this, as always. Really appreciate it. Thank you. All right, Josh, going to send it over to you.
All right, Julie, we're taking a look now at shares of Micron. Micron, as their third quarter results hit the wire. Let's break down those numbers. They're looking for Q3 adjusted EPS. They report of 62 cents. That's versus expectations of 50 cents. And Q3 revenue clocks in at $6.81 billion versus expectations of $6.67 billion. So beats there on the bottom and the top. Let's look ahead now to what they're guiding for Q4. They say to look for EPS between $1 to $1.16. Consensus was at 102. Revenue, they say, they give a range here. They're looking for between 7.4 to 7.8 billion. So at the midpoint, that is basically in line with what the street was looking for, Julie. The street was at 7.58 billion. At least initially here, you can see the shares are down in the after hours.
I'm trying to figure out why the shares are down in the
I don't know.
hours.
I'm looking too. I mean, I wonder if, in part, if maybe the Q4 guidance is basically in line at the midpoint. Maybe that wasn't enough, given especially the move the stock has made. I mean, it was up more than 60% just this year heading into the print. It was up about 120% in the past 12 months. But I'm looking for other data points as well, seeing what could explain that.
Yeah, I mean, if you look at the midpoint of that guidance, it still seems to be above what folks are looking for. I'm looking in the statement here. By the way, the stock is up about, 60-some%
yeah, huge move.
Year to date here. And a lot of the thesis on Micron, which has been, we talk about semiconductors all the time. There are a lot of different kinds of semiconductor makers, as we have learned. There's Nvidia with the very advanced chips. Micron is a memory chip maker, which has been a part of the chip business that is particularly cyclical, particularly commoditized. What the thesis has been with Micron and what might be changing is that it is now making a bit more of a more advanced chip within memory, that it's called its high bandwidth memory chip. And that's something that is now in higher demand related to AI. And indeed, Sanjay Mehrotra, who is the president and CEO, saying in this statement, we're excited about the expanding AI-driven opportunities ahead. And he says, are well positioned to deliver a substantial revenue record in fiscal 2025, which I think is interesting there. So we'll keep digging in here and see exactly what's going on.
I just wonder if what's going on, at least initially here, is back to what the stock did into the print.
Yeah.
The expectations were just out of this world heading in.
It's true.
Yep.
All right, we're going to get more on Micron with an analyst later in the hour, but for more on the market action from today, let's get over to our Jared Blickery for a closer look. Hey, Jared.
Hey there. Well, at least the Dow and the Nasdaq ended on the same side of the market, both in the green today. That is a trend we've been tracking, but there is some dispersion within the indices. And if we can go to the Wi-Fi Interactive, I will plot the day's price action. Here is the Dow. You can see started off in the red, climbed into the green, and pretty much stayed there for the rest of the day. Although, again, these are very, very small gains, 15 points, basically nothing. Here's the Nasdaq up about 0.5%, slightly different looking chart there. And we can also take a look at the Russell 2000, which spent the entire day in the red there. I will note that volatility stays relatively muted. In fact, these are historical lows. I'll show you a 3-year chart camping out the bottom end of this range here. So pretty low volatility in stocks. And if you take a look at the MOVE index, let me just dial this down to a year-to-date chart. ICE BofA Move Index, well, that's a little bit higher than the VIX relative to its year-to-date price action, but we will call that lows of the day. Let's take a look at the sector action. Consumer discretionary was flying high. It is the only sector that outperformed, and it was up by a large margin, 1.5%. Communication service basically flat there. Energy trading to the downside off 1%. But the story, when you look inside the NASDAQ, that XLY, guess what its two biggest components are? Tesla up almost 5% there, and also Amazon, that was up 3.9% today. So XLY outperforming. You'll also notice that tech has some nice gains from Apple and Nvidia and Microsoft, but those three gains right there, those gains among those three mega cap sectors, not enough to put it in the green. And if you take a look at the heat map for semiconductors, I'm just going to put the after hours market chart on here and quotes because things are changing. Nvidia was up 0.25% for the day. It's down 1.25% after those Micron earnings. And taking a look at Micron itself, down 6% in after hours trading. Price perfection, you don't miss your mark, you don't hit the mark, you're going to get a sell-off here, guys.
Jared, thanks for the perspective. And we're going to be talking more about Micron. On the other side, in fact, we'll take a closer look at the company's results with an analyst. More market domination overtime coming up.
Micron shares sliding after hours despite a beat on the top and bottom line. Synovus senior portfolio manager Daniel Morgan joins us now to discuss. Dan, it's always good to have you on the show. And maybe then we'll just start, big picture. Give us your take on this Micron print, Dan. What'd you make of it? At least initially, in the after hours, investors seem disappointed. Stock's down about 8%.
Yeah, it's interesting, Josh, because you read those numbers off for the third quarter, and there was a big beat, right? 6.8 billion versus 6.6 billion in revenues, and then the consensus estimate earnings per share of 50 cents. It came in 62 cents. Then we flip over to the guidance going into the fourth quarter, and if you look at the midpoint of their EPS range, it'd be about $1.08 a share, which is above consensus, which was about $1. But it looks like the stumbling block right now, Josh and Julie, was that revenue number. 7.6 billion plus or minus 200,000. That's exactly what the street was looking for. And it seemed like before I came into the studio, I was looking over kind of what the expectations were. And the motto really seemed to be beat on the third quarter and raise on the fourth quarter. And the fact that they didn't raise that revenue number and they came in line, I think that, Josh, is why we're seeing the stock sell off a little bit.
And if you look also at the sort of forward PE on this, Stan, it's high. A
little bit.
Yeah. So, when we just heard Jared saying a few moments ago, the stock is trading near a record. It's got this high PE. So I guess, does that leave them pretty small margin for any kind of error or perceived error?
Yeah, what's interesting, Julie, is if you look at the price to book, which I like to look at when I analyze, semiconductor stocks, stock trades at about 16 times forward earnings. So you're right, it's kind of high for Micron. But we look at that price to book level right now at 3.6 times, averages about 1.7 times book. And they've traded in a range in the last 5 years about 1 times book to 3.6 book. So they're on the high end of their price to book ratio. So I think you're right. The stock has made a big run up. Everyone's been very excited about how AI is impacting the memory business, especially in DRAM. We'll get more of that on the conference call with their high bandwidth memory chips. And that's kind of made a big catalyst to move the stock higher and really push up those valuation benchmarks. So there, like you say, Julie, there just wasn't a lot of room for error. They had to beat and raise to really drive that stock higher based on the current valuations.
As you point out, Daniel, listen here, at least knee-jerk after hours, it's getting hit, but the move in this stock was absolutely tremendous this year and over the past 12 months. I mean, clearly investors had really decided that Micron is just a smart way to play this mega AI trend, that it was going to benefit from AI servers and AI-enabled PCs and smartphones. Do you agree with that, Dan? Is Micron, do you think, a smart long-term way for investors listening right now to play that AI trend?
Josh, to be honest with you, if you look at Micron in terms of the expectation for revenues coming into fiscal year 24, we're closing down next quarter. They'll probably do about 5% of their revenues in what is called high bandwidth memory. That's the AI memory chip that everybody's really excited about. We know that Micron will mostly track with the rollout of the H200, which is the Hopper 200 Nvidia chip. So a lot of people feel that Nvidia is going to be using Micron's high bandwidth memory chips for their H200. So obviously, if Nvidia is doing well and they're rolling out the Hopper 200 and it's going really well, then the expectations were that we would see that come down into the Micron number. So to answer your question, though, Josh, in terms of percentage of revenues that they get directly from AI, it's not nearly as high, let's say, at Broadcom, which is about 15 to 16% of revenues. AMD should get more revenues due to their MI300, their MI300X and MI300A chips. So anyway, I don't know, Josh, if Micron is the best chip player to play AI, if that makes sense.
So I guess who would be? First of all, do you guys own any? Do you own any Micron? But sort of how are you thinking about that strategy right now?
Yeah, in the AI space, obviously we own Nvidia. We've talked about that before on previous shows that we've done together. We own Broadcom, which is another play in that space, Applied Materials in the capital equipment area. Names that we don't have on our buy list, but names that people could look at. Obviously, we mentioned AMD. That's a name. Marvel Technology would also be a name in that space. So those would probably be the top. Nvidia, Broadcom would be kind of top of that heap right now in terms of direct AI plays. Again, Micron is a DRAM producer. It's a very much of a commodity type of chip that they make. And their total amount of revenue directly tied to AI, at least from previous calls we have, has not been as substantial as, let's say, an Nvidia or, let's say, a Broadcom.
Right, got it. Dan Morgan, thanks so much for your insight. Appreciate it. It was helpful. Well, from chips to denim to jeans, let's talk about Levi Strauss. That company's second quarter results crossing as well. And those shares are also trading down quickly here, about 17%. Wow. Now, the company's earnings per share beat estimates by 5 cents, but the revenue a little bit below what analysts had been anticipating, $1.44 billion. The estimate for $1.45 billion. The company leaving its full year forecast unchanged here. And those net revenues rose 8% year over year. In the Americas, revenue was up 17%, but in Europe they fell 2%, and in Asia, just about in line with last year. Didn't change.
This was another one of those names, Julie, where it had run hard into the print. It was up about 40% this year. Under Michelle Gass, new CEO, relatively new on the job still. I mean, she does here in the release talk about the kind of pivot they've been making here to more of a DTC, direct-to-consumer first company. She's really trying to sound this positive, confident tone here. She's saying, listen, that pivot is yielding what she calls positive results around the world, says she has great confidence they're going to achieve accelerated profitable growth the rest of the year and beyond. But clearly investors, at least initially here, disappointed.
No, definitely it seems that way, doesn't it? Well, we're going to dig more into the Levi's numbers because Levi's Chief Financial and Growth Officer, Harmeet Singh, will join Catalyst tomorrow in the 10 a.m. hour.
All right, time now for what to watch for Wednesday, June 27th. Salesforce has its annual shareholder meeting voting on executive plans and electing board members. Investors are going to listen closely for clues from the company about slowing growth concerns and potential opportunities for AI.
We'll also be getting another batch of earnings tomorrow. Nike, McCormick, Walgreens, and Polestar will all be reporting. Nike announcing fourth quarter results after the close. The company had a better than expected third quarter. Analysts expecting those results to drive product innovation and boost sales. We'll also have McCormick CEO Brendan Foley on Yahoo Finance tomorrow at 4 p.m. Eastern.
And new data on initial jobless claims will be released as analysts predict a slight drop in the number of individuals who filed for unemployment insurance for the first time during the past week.
And finally, the first presidential debate is tomorrow, and the future of U.S. tax code will be a large focus, with President Biden advocating for a higher corporate tax rate of 28%, and former President Trump continuing to argue for tariffs on consumer, intermediate, and capital goods from China. That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere on the other side of the break. It's Asking for a Trend. I've got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned. Hello and welcome to Asking for a Trend. I'm Josh Lipton. For the next half hour, we'll be breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here are some of the trends we're going to be diving into. Stocks ending the day higher as a lack of catalyst did leave the broader markets little change. Nvidia shares managed to recover the day's losses after breaking their losing streak yesterday. Plus, can you put a price on value? Apparently you can. McDonald's debuting its $5 meal deal to win over inflation-weary consumers after a rougher than expected first quarter. And pharma goes to space. The pharmaceutical industry is discovering the benefits of zero gravity in drug development. We're going to hear from one of the companies that's helping them reach the stars. Dining out is here to stay. It's according to new research from commerce platform Lightspeed. More than half of survey respondents said they plan to dine out at the same pace or more frequently over the next 6 months. But value is now top of mind. Lightspeed's CEO Dax De Silva joins me now. Dax, it is always good to see you. So you guys it was an interesting sounding survey. You're trying to get a read here on dining trends. So let's start there, Dax. What did you learn? How have dining trends been evolving?
So Americans love dining out. You know, our restaurant software is installed in restaurants across Europe, Asia, and North America. And Americans are still dining out, as you saw from that stat. 51% plan to increase their dining out in the next 6 months. But 81% are dining out once a month or more right now, and 39% once a week or more. And so you just mentioned something about McDonald's. Fast food has gotten more expensive. And so casual dining is becoming more popular because it's competitive with what fast food has become in terms of price. So consumers are really looking for that value, value for the dollar.
And how does this I was interested reading through the survey, Dax, how some of the knock-on effects. For example, if people, they still want to eat out, but bottom line, they're looking to stretch that dollar, right? How does it affect other things that might go on inside a restaurant? For example, does that impact how people think about tipping?
Oh, tipping. I think consumers are reaching the tipping point a little bit on tipping. There's a lot of pressure, as you see from these stats here. There's a lot of pressure to tip. 58% are feeling that pressure. 44% say that inflation has affected their ability to tip. But Americans are the most generous. Across our survey, compared to Europeans or folks in Asia, Americans still tip close to 20%, and a good percentage tip above 20%. So even though Americans are feeling the pinch of inflation, the generosity is still there on the tipping side.
Now, we've spoken, another trend I want to get your take on, Dax. We have different restaurant CEOs come on Yahoo Finance, and often they'll talk about how enthusiastic they are about integrating technology into their restaurants. In your survey, what did you pick up there? How do consumers actually feel about tech when they dine out? Do they react positively to maybe this kind of innovation?
Well, of course, one of the things that we surveyed was the QR code menu. And that is not popular. 89% prefer a physical menu. You could probably relate to that. I personally don't love it. But 34%, a good third, actually hate it. So this was a COVID measure that kept us all safe during COVID. But folks prefer the physical menu when they go out. I think that restaurant tech is really helping the back end, the back office of the restaurant, be more efficient on food costs, helping also to facilitate other things like delivery or pickup, so that consumers can have the choice they want and how they receive their food. But the QR code menu is not the most popular.
I do get that. I mean, believe me, Dax, when I go out, I do prefer that kind of physical menu. I am kind of curious, though, when sort of the reactions to the tech, to the QR codes, did that differ depending on the demographic?
Yeah, 18 to 34, 55% of 18 to 34 were affected. Sorry. Yeah, no, I think definitely the older folks, don't love the QR code menu. Those that are younger, that are a little bit more adept to the tech, are okay with it. So I think it is a generational thing. I think everybody had to get used to it during the pandemic. But now that has subsided, everyone is looking to enjoy the physical menu as a part of their restaurant dining out experience.
And you all, Dax, you got a ton of data over there. I'm just curious, besides restaurants, any other big trends you're kind of picking up right now in other sectors, other industries that you'd highlight?
Yeah, we're seeing in retail, we're definitely seeing some of the outdoor verticals in retail start to pick up. We in our last quarter we reported that home and garden, sporting goods, were probably going to trend up, and other verticals like clothing and so on would probably trend down as we approach summer. So these are some of the things that we're seeing in retail verticals. But when we report our next quarter in August, we'll have more data on what we actually saw in the summer and how those verticals sort of fared as the weather and the seasons have changed.
All right, Dax, that'll be a great time to get you right back on the show.
Yeah.
Thank you, sir. Always good seeing you.
Good to see you.
Coming up, under pressure, the results of the Federal Reserve Bank's stress test next on Asking for a Trend. The results from the Federal Reserve's annual stress test for banks are out. And join me now with the results, Jennifer Schonberger. Jen.
Josh, results from the Federal Reserve's stress tests show all 31 of the nation's largest banks could continue lending to households and businesses during the severe global economic recession, with plenty of capital on hand to absorb those losses from loans. Now, this even as this year's test resulted in higher loans because banks' balance sheets are somewhat riskier and expenses are higher. The results demonstrate the strength of the nation's largest banks as they push back against proposed capital rules that would see their capital raised as high as 20% under Basel III. Now, the Fed's stress tests were mandated annually by law after the financial crisis for banks with $100 billion or more in assets. They examine how the banks would perform during a hypothetical severe recession to prevent bank failures in a crisis. This year, the hypothetical scenario envisions a severe global recession where unemployment spikes 10%, home prices plunge 36%, and the stock market plummets 55%. Under that scenario, all 31 banks in aggregate would lose nearly $685 billion. Yet after covering losses, banks would still have capital left over equal to 9.9% of total assets weighted by risk. That's well above the 4.5% the Fed requires. Now, the hardest hit area under the hypothetical scenario was credit cards, with losses amounting to $175 billion, or 26% of total loans lost. Commercial and industrial loans coming in a close second there. Now, taking a look at how the nation's largest banks shake out, you can see all but two have capital that's double or more the Fed's minimum capital requirements. The mid-sized regional banks, including PNC, Truist, and M&T, also above the Fed's requirements, but not as high as their larger peers. Now, for the first time, the assessment also included an exploratory analysis for the largest banks, which assessed how they would fare during a global recession if there was a sudden flight of deposits or their hedge fund counterparts failed. The largest banks were able to absorb those shocks. No capital consequences for the exploratory portion, though it will be used in the supervisory process for the nation's largest banks. Now, Josh, banks are going to use results from these stress tests to determine how much capital they will give back to shareholders in the form of dividends and share buybacks. Capital plans for each individual bank are expected to be announced after the market close on Friday. Back to you.
All right. Thanks, Jennifer. Appreciate it. U.S. stocks closing higher than Nasdaq, leading gains as Amazon hits a market cap milestone. We have Yahoo Finance's very own Josh Schaefer joining us now with more on the trading day takeaways. Joshua?
Amazon star of the day,
Takeaway
Josh.
number one. There we go.
$2 trillion market cap for the first time ever. And let's take a look at our board here of the Nasdaq 100 and the other mega caps. I'll pull up the actual cap weight that we see. So here we go, market cap there. You can see Amazon closing above 2 trillion for the first time ever. Let me exit on out of that, right there. And then, so it's below still these other four, but it's the fifth tech company in the US to rise over 2 trillion. And what really stands out to me about this, Josh, is when we just take a look at the market action both today and over the last week. So Amazon up 4% today, really kind of carried the market, is what drove the Nasdaq higher. And then we talked a lot about Nvidia over, I guess, really the last year, right?
Yep.
But specifically over the last month, right? So if we look over the last month, Nvidia has had a nice run even with that pullback. It's the best performer of the mega caps. But you look here, it's been interesting. The other Mag 7 stocks that we talk about a lot, Microsoft up over 5%, Apple up over 12%, Amazon itself up over 7%. And then you look over a 7-day period when Nvidia started to fall off a little bit, you see Nvidia in the red there. What's been helping us? Because the S&P 500 hasn't fallen that much while Nvidia's lagged. Well, it's the other big stocks like Amazon. So it's just sort of a reminder, we talk about Nvidia all day long, but there are other big stocks that also have big weightings in the S&P that can help the index close higher if Nvidia isn't just going up every day.
It also speaks, Josh, that's also, this, and you've written about this theme that investors are so focused on, which is this rally is, narrow, right? You hear that, it's being led. It's kind of big tech outperforming everybody else. And it's interesting how strategists kind of think about that, because some have come on the show and said that is, a giant yellow flag.
Right.
But there's other, and I know you've talked about this, you've written about this in columns, saying others say, relax, enjoy the ride.
Yeah, I mean, I'll put this on a year to date so you can see how some of the mega caps have been doing. Pretty decent gains, I would argue, for all of these stocks, right? And the take is from those strategists is, well, this has been driven by earnings. When you take a look at some of these stocks, the earnings estimates just keep moving higher. If earnings are going up, then that's considered sort of a good fundamental trend for the stock, right? And a reason for it to go higher. So if that's what drives the rally higher, then people think that can be okay. At some point, do you need everyone else to participate? Yes, but for now, maybe you can survive with big tech continuing to outperform.
All right.
But we got more takeaways.
Give me Schaefer take number two.
Takeaway number two. This is more something to watch going into tomorrow, but I'm particularly interested in weekly jobless claims, and here's why. So they come out at 8:30 every Thursday. They're not always a notable release. This is how many people are filing for unemployment. But if you take a look at the trend we've been seeing here, really for the last month, it's been higher. This number here was above 240,000 filing about 2 weeks ago. That was the highest we had seen in 10 months. And so a lot of folks right now talking about some softening we're seeing in the labor market. We know the unemployment rate has been ticking up. It will be interesting to see when we get this release tomorrow morning if this sort of trend higher starts to continue, because if it continues for several weeks, economists will start to get a little bit worried about what's happening.
And that's the question for you. Just remind viewers, if you're a viewer right now, you're an investor, why do you pay attention to this? Why should that economic data point just kind of be on your radar?
So initial jobless claims, as I said, comes out every week, right? So it's considered one of the better real-time indicators, because we get the jobs report, it comes out every month, but that's looking back at, so next week we'll get the June jobs report. That's looking back maybe at a trend that we saw the first week of June, the second week of June. This is last week, right?
Yeah.
And so it's a little bit more real time of what's happening. And as people get laid off, they're gonna go and file for unemployment benefits at some point, most likely. So you start to get a little bit more sense of what's actually happening. This is one of the key indicators when people talk about recession risk. If jobless claims tick up, that's where the big concern is.
All right, hits tomorrow. We'll be watching. Yeah. Thank you, Josh. It is Space Week here at Yahoo Finance, and Akiko Fujita got a chance to sit down with Varda Space Industries co-founders Will Brewy and Delian Asparuhov to find out why and what space manufacturing could actually look like. Take a listen.
There's definitely a couple different categories of space manufacturing. We really focus on space manufacturing for use down here on Earth. So that means you basically take precursor material from here on Earth, fabricate it, modify it basically in the unique microgravity environment of space, and then bring it back down for use down here on Earth, which we believe is basically the largest and nearest term, basically commercial market application. There's definitely another category of space manufacturing, which is sort of like manufacturing things in space for use up in space, but there's not a whole lot of buyers or customers up in space. Most people that buy things are down here on Earth, and so we focus more on that, sort of former category.
Will, what makes microgravity so conducive to pharmaceutical research?
Yeah, so microgravity will affect the outcome of chemical systems. So that's the fundamental thing to understand, in the same way that temperature can change the outcome of chemical systems. So microgravity is free in outer space, it's ubiquitous, and it's impossible to create in perpetuity on Earth. And so we essentially are building space manufacturing modules because we can change the outcome of chemical systems like no one else can on Earth. And all right, so which chemical systems should we change first? Pharmaceuticals is the clear answer from both an aspirational, what's the best thing for humanity aspect, and also from a dollars per kilogram perspective. It's a large market and the most expensive chemical systems per unit mass.
And we're not the first to think about this. People have been talking about sort of pharmaceutical manufacturing in space over the past 50 years. The current NASA Administrator, Bill Nelson, was doing this in the early 80s. Tons of large top 20 biopharma have done these types of small-scale experimentations on the International Space Station. Merck, Eli Lilly, Janssen & Janssen, Bristol Myers Squibb. And in 2019, Merck actually published a particularly interesting result where they actually took their blockbuster monoclonal antibody, Keytruda, does $25 billion of revenue for them every year. Financial analysts estimate that it represents about $125 billion of their market cap. They were able to show that, as Barry mentioned, when you turn off gravity, the chemical system changes, and it changed in a very unexpected way. And the result of that change was they actually found a drug, a version of the drug up in space, that rather than having to be delivered the way that it is today via an intravenous drip, where you're going in once every sort of 2 weeks for sort of 4 or 6 hour appointment, it's hugely disruptive. Instead, they could actually just send you home with a syringe that you could take in the safety and comfort of your own home. And so it's a huge outcome for patients. It's a huge outcome, obviously, for Merck, because they now have an improved performance drug that extends their patent window. But ultimately, the International Space Station wasn't a place where they could do this at a sort of commercial scale, sort of low cost, high cadence. The sort of thesis behind Varda was, well, SpaceX has made it so that reusable rockets made it so that access to space was sort of very cost effective. But we needed to offer them a platform that was also cost effective, that didn't have humans on board, was low cost, autonomous, and could do all that sort of pharmaceutical work. And so we work with top 20 biopharma and mid-stage biotech to help them sort of get results like what Merck got in 2019.
In the simplest terms, when you talk about sort of crystallization, for those who aren't as familiar, I mean, what is it about microgravity that makes it good for that process?
Totally, and when we say the word crystal, we just mean essentially like a powder, like you would see pressed into a pill. The reason it's called a crystal, the technical term, is just how the molecules are arranged. And how the molecules are arranged are fundamental in the macroscopic properties of the drug. So an example would be like a graphite pencil versus a diamond. They're both just carbon atoms, but they're arranged in a different way. And so that arrangement defines the difference between the hardness of the diamond and the softness of your pencil. And for our pharmaceutical companies, they care about things like solubility. How quickly does this dissolve in the bloodstream? So that's a macroscopic property that depends on how the atoms are arranged, or in technical terms, the crystallization of the product. So in microgravity, there's less disturbances from the crystallization process. And so you see these crystals nucleate in suspension rather than sinking, causing turbulence, sedimentation, buoyancy. All of those effects are removed in microgravity, and therefore you can create different atomic structures and therefore different macroscopic properties. So Delian gave a great example of going from an IV bag to a shot. Another one would be like a pill to an inhalable, because you can make the particle size distribution more narrow. So we don't invent drugs per se. What happens is the pharmaceutical company will come to us with a molecule, and we would say, hey, we can convert that molecule into a better version of the medicine using microgravity, in the same way that another formulation provider on the ground might say, we have some special technique on the ground that can also change the formula, like a special ingredient or something like that. So our business model is not novel. Like, there are tons of formulation platform companies that work with top 20 pharma and mid-stage biotechs to provide formulations. We are just one that has a knob, being gravity, that no one else has.
Space, an area of exploration, mystery, and home of the internet? As scientists and astronauts explore the deep unknowns of space, space is simultaneously being used to provide internet connections to millions of people on Earth. One of the largest companies using satellite technology to provide internet access to the masses is Elon Musk's Starlink. The company was founded in January 2015 when SpaceX announced its satellite internet proposal. At the time, Starlink remained nameless. The company would take 3 years to launch its first 2 Starlink test crafts in February 2018. By May 2019, the first 60 Starlink satellites were launched. Fast forward to today, and Starlink has created the first network of interstellar satellites resembling a low-orbit satellite constellation capable of delivering broadband internet worldwide. There were over 6,500 Starlink satellites in orbit as of June 2024, according to astrophysicist Jonathan McDowell. A satellite's distance from Earth significantly affects latency. Latency is the time it takes for a signal to travel to and from the satellite in space. Satellites have different locations in space. There are 3 key types of satellites orbiting right now: low Earth orbit satellites, which are closest to Earth; medium Earth orbit satellites, which are roughly 1,200 to 22,000 miles away and are located between low Earth orbit; and geostationary satellites, which are the furthest away out of the 3. The further away the satellite is, the greater the latency is. Because Starlink operates low Earth orbit satellites, which float around in space about 550 kilometers or about 342 miles from the Earth, the company is able to offer high-speed, low-latency internet connections. Conversely, traditional internet service providers use single geostationary satellites that orbit around 36,000 kilometers or about 22,370 miles away from Earth, creating a more high-latency internet connection. While Starlink is the space leader, there are other competitors in the low Earth orbit satellite sector. Amazon, Biostat, Globalstar, HughesNet, Eutelsat OneWeb are just some of the players in the sector. Amazon's Project Kuiper is an initiative to provide broadband to unserved and underserved communities by using a constellation of more than 3,200 low-orbit satellites. Founded in 1986, Viasat's primary fleet are geostationary satellites to deliver bandwidth. Eutelsat OneWeb is a satellite communications operator with over 630 satellites in low Earth orbit. The advantages of high-speed internet and vast availability provide benefits for both personal and business use, including streaming, gaming, intelligence, and surveillance. What will the expansion of the low Earth orbit satellite market and the growth of competitors mean for Starlink's future?
S&P 500 performance and breadth hit one of the biggest dislocations in 30 years. Yahoo Finance's Julie Hyman joins me now with a closer look. Julie.
Yeah, Josh, we've been talking so much recently about breadth, right? How many of the stocks in the various indices are participating in the rally? And the answer is not that many, right? Because they're being carried by big stocks. So Bloomberg Intelligence has one particular look at this. So this here is just the S&P 500. And of course, we've been seeing it climb and climb and climb, making new records on a pretty regular basis. Now take a look. Overlaid with that is the percentage of stocks in the S&P 500 that are trading above their 200-day moving averages, that have broken out, that have participated in that same momentum. And as you can see here, there is a divergence. The S&P is going up, but the number of stocks that are really participating in that upward momentum is not participating to the same degree. And then we've highlighted a few areas here because these are areas that Bloomberg Intelligence has highlighted here back in 2001 and then 2003 when we saw similar gaps here. So it's near the widest that it has been between the S&P and the percentage of companies within it trading above that moving average. It's near the widest we've seen in 30 years indeed.
So as you, Julie, look through these charts for investors watching right now and traders, does it suggest a potential slump could be coming?
Well, it depends on who you ask, as is typical with these kinds of situations here. So the folks over at Bloomberg Intelligence, they looked at these two other times in 2021 and in 2023. And after that, we did start to see some movement downward in the S&P 500. So they say it could portend a slump. But we also earlier talked to Mark Newton of Fundstrat, and he did not seem as concerned about this particular indicator.
It doesn't have to mean that the market is going to go into a correction or roll over. Those tech stocks can continue to go up, and the divergence can get wider and wider, similar to what we saw back in 2021. However, we can also see what I think is going to happen is as a start of the broader market to play catch up. And we've seen a little bit of that in financials over the last week.
So he thinks 5650 is what we're going to see on the S&P 500 before the end of the year, and then perhaps a little bit of downward pressure.
All right, Julie, thank you for that. And that is a wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern. Have a great night.